I'm Pierre Daly, managing editor at advisoranalyst.com. Co-hosting Raise Your Average with me today is Rodrigo Gordillo, president at Resolve Asset Management Global. Every stock market correction is unique, with its own causes and consequences. There are some similarities between the current market decline and past declines. And following a period of speculation and excess in 2020, tech stocks have taken a beating. It's reminiscent of the tech rout in 2000 when value stocks outperformed technology stocks. This is definitely a correction with its own unique flavor, and despite tech stocks making up a bigger part of the stock market than ever before, the S&P 500 actually remains resilient. Just take a look at the equal weighted version of the S&P for some clues, and you'll see that it's down just 6.8%, while the S&P is down close to 11. What it reveals is that value stocks are finally shining. In fact, value stocks are outperforming across the board in this stock market. Value is outperforming large cap US, small cap US, foreign developed stocks, as well as emerging market value. And here to talk about both US and international value investing with us are Stephen Jenkins and Jackie Au, portfolio managers at Siona Investment Managers. So stay tuned. Stephen joined Siona in 2019. He's the co-chief investment officer. He's also co-lead portfolio manager for Siona's high conviction strategy and the lead portfolio manager for the firm's global value strategy and focused U.S. value strategy. He began his career in 1990 as an analyst at Royal & Sun Alliance Insurance Company and has most recently been a senior portfolio manager and senior vice president at CI Harbor Funds. Jackie joined Siona in 2013 following a summer internship and is a portfolio manager. He's also co-lead portfolio manager for the firm's focused dividend strategy.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of advisoranalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Stephen, Jackie, thank you so much for joining us.
Thank you, Pierre. Pleasure to be here and looking forward to our conversation.
To kick things off, Stephen, Jackie, please tell us about your backgrounds, the arcs of your careers, and what you do at Siona.
Sure. You don't mind, Jack? I'll go first, and then you can
go right ahead.
You can take over. Yeah. So as you mentioned, I started my career in 1990. Graduated at a business school, Wilfrid Laurier, and if you recall, it was a good recession that was starting at that time.
Yeah.
And it was interesting. I had lined up a job out of school with a small brokerage firm as a kind of an assistant analyst, and was also planning to travel Europe when I was finished school, which I did. And the firm said, get in touch with us when you come back. And lo and behold, the Canadian branch of that firm went under while I was away. So, I started my search and landed expanding kind of where else is the investment world I'm going to touch other than the brokerage world, and landed at Royal Insurance and in the investment department. And oddly enough, Kim Shannon hired me into the business, and I work again with Kim now at Siona, who is the founder of Siona and co-CIO. So started my career with Kim and kind of cut my teeth there and learned the ways of value investing, and started as an analyst and worked my way up to an assistant PM. But also interesting was everyone at the shop took a turn at trading as well. So I did a lot of trading and assisted on the desk, and then laterally was doing all the equity trades. Left Royal about 5 years later, early 96, I guess it was. And I hooked up with Jerry Coleman, at the Ivy Funds at Mackenzie. So another esteemed Canadian value investor. And he really helped kind of round out my my career and my thoughts on value investing. And it was played a very important mentor role for me in my career. Shortly thereafter, Jerry was hired away to launch the Harbor Funds at CI in 97, and I went with him at that point in time, and we launched Canadian portfolio, both large cap and a small cap portfolio at the time, and launched it with great fanfare, to be honest. It was at a good time. And it was interesting, and this will tie into our conversation today. Within a year or so of that successful launch, we started to feel the pains of the tech bubble, quite significantly. We raised a lot of money out of the gate, as I said, but in short order, a lot of folks were questioning what we were doing because we couldn't find any value in tech, and we didn't own any, frankly. And even in Canada, not owning Nortel at the time was, it was painful. So it was a lot of underperformance, certainly, leading up to that peak of the tech bubble. And there was, I think, probably questions whether Harbor would continue at CI. But shortly thereafter, after the tech bubble burst, we were vindicated, and our style went on to outperform for the next decade or so, kind of top decile performance. So, staying tried and true to our process of value investing. And, as you mentioned, Pierre, we're seeing a lot of similarities today. So we grew Harbor to about 16 billion in assets. About 6 billion of that was outside of Canada. We launched a global mandate in 2002, which I spearheaded and ran. And then I left CI and Harbor in 2016, took a couple of well-needed years away from the business and started chatting to Kim again towards the end of 2018. Came in early 19 to help launch a global initiative and have since also taken on a co-CIO role. So I'm overseeing the Canadian team alongside Kim and the Canadian portfolios as well. So that's kind of where we are today. And maybe I'll let Jackie chime in terms of his career.
Yeah, happy to. So I went to school on the West Coast. I first joined Siona as a summer intern. That was about 11 years ago. I didn't know much at the time, but I must have done something right because the firm brought me back on as a full-time analyst after my graduation. And I've been there since then, picking up more responsibility as time went on, from covering different sectors to different geographies, learning about different business models, doing portfolio construction and risk management, and even helping develop our ESG strategy as well. So it's been a colorful and fun journey. Today, I spend my time analyzing Canadian, North American, and global equities. And I'm one of the leads on our dividend strategy as well.
That's great background. And before we get into the nitty gritty of the strategy and talk a little bit more about Siona, I'm actually genuinely curious for every value manager. What is it about value versus growth? Or, there's so many styles right now, quality, low vol, equal weight. What is it about value that seems to attract the most amount of people into that space? And what would keep you going after 10 years of struggle that we've seen, and probably the most struggle we've seen in our lifetime for value?
That's a great question, Rodrigo. Let me take a stab at it, and Jackie, if you want to chime in, please do. So, I think just at the essence of it, the notion of buying a piece of a business, we've always felt that way. We're buying a piece of business, not just a piece of paper called a stock. But being able to buy into a company at a price that's below what we deem its long-term fair value or underlying business worth to be, just intuitively makes so much sense. I don't know why you would do it any other way. Why would you overpay for something? And so I think just on a very simplistic level, it's always made a lot of sense. And we've all heard this notion that everywhere else in our life, we're quite happy to go out and find something on sale and, back up the truck kind of thing. But in the investing world, there's often a lot of apprehension when something appears to be on sale, because there's generally some hair on it. There's some issues perhaps with the stock, short term or maybe even longer term, and which is creating that discount. But I think just that the simple essence of being able to buy something at a discount. But I'd also say, for me over my career, I've always felt that growth and value are inextricably linked. of course, we want to buy a business that's growing over time. We tend to buy businesses that are growing, but not, at explosive rates, more consistent and durable type of growth rates. So of course we want our business to be growing over time. We just don't want to overpay for that growth. So, I feel growth and value from that perspective are inextricably linked. And it really just comes down to the price we pay for a business. So, yeah, and then to your last question about, how we're feeling today and after 10 years or so of underperformance, I'd say the value keeps doing what it's always done. You look over the past decade and the value factor, if you will, has still produced decent absolute returns in line with what it would have done in history. It's just that relative to the explosive returns that we've seen from growth, which we also saw back in the tech bubble days, relatively it's been a very poor underperformer. But on an absolute basis, it continues to do what it always does, and we expect it to continue to do that going forward. Can I say the same about growth at the moment? I don't know. I think it'll be more challenged to deliver those types of returns that we've seen in recent years. Jackie, why don't you?
Jackie, what made you? Who hoodwinked you into smashing your head against the wall?
That's exactly. You know what, Rodrigo? I was thinking, Jackie. When you were talking about when you're sharing your bio. I was thinking, that's a really difficult time to come into this area of investing, or this specialty. So I was curious, but go ahead.
Yes, no, certainly. I mean, I think personally, I was enamored by the writings of, Ben Graham and Warren Buffett. And I suspect a lot of people who buy into the teachings also kind of came in through, the same readings, right? Obviously, Warren Buffett, Charlie Munger, very successful investors. And I know a lot of my peers can quote their sayings right off the heart, right? So, the other thing I'll say is that, and Stephen alluded to this as well, there's a lot of different flavors of value, right? Some go deep value, buying assets at, their underlying asset value. There are groups like relative value, which is what we are. We're looking at, relative multiples, to even some flavors that verge on being growth investing. And those investors are willing to pay for, foreseeable earnings growth or cash flow growth. And all of them call themselves value. So you end up with a large swath of different kinds of investors actually calling themselves by the same name, without getting into the nitty gritty of distinguishing. And I suspect that's why you hear that a lot of people, call themselves value investors. But the other thing I would say, and you asked, what keeps me going after such a long and cold winter in value investing. I suspect, and I'm not a macro guy, and I don't like to prognosticate, but I think we're coming to a point where the macro environment is proving to be a little bit more friendly to value investors. I think interest rates and inflation starts to lift off the ground. I think economic cycles and economic growth are starting to return. You're starting to see the beginnings of that, and there's, commodities are in vogue again, and there's a real demand and shortage of supply in that space. I think all of these things bode well for value investors. So you're right. It's been a long wait, one that has been strangely longer than usual, at least by historic standards, but it's coming back. And certainly, a lot of the team members at Siona are certainly very excited to see a turn. We're seeing it in our performance numbers as well, as of 2022. And so we're happy to see that we suspect that it'll continue, and we'll see what's the rest of the year has in store for us.
So let's dig into that a little bit, this turnaround, and also, Stephen, the turnaround that we saw in 2000 for value. What is growth investors' kryptonite, and what causes the rotation away from growth towards value? What are the macro or micro changes that cause that, in your opinion?
Yeah, good question. And there's certainly there are some similarities to 2000. Absolutely. And I think at the time, if I recall, you didn't know when it was going to happen. and it just felt like it was collapsing under its own weight at the time, with valuations where they were, and then couple that with a lot of disappointments in terms of the underlying expectations of the businesses. And I think that played one of the biggest roles back in that day, was just the expectations built into the stocks, suggesting that, in order to kind of earn that multiple, the growth rates that the businesses would have had to have delivered over the next decade or 20 years we're at rates that had never been seen before. So it was just kind of collapsing under its own weight of expectations. Today, we're coming off of 40-year downtrend in interest rates, very low inflationary environment for such a long period of time. That downdraft in rates, and certainly in the last decade or so, has certainly helped push higher the multiples on longer dated cash flows from growthier companies. I think that's played a very big role. And that's probably playing one of the biggest roles we're seeing today in terms of starting to unwind some of those premium multiples. But in addition, we're starting to see it now too, the fundamentals of the businesses. The expectations were high. We saw it this past week with Netflix. Businesses, when they don't meet those expectations and they have lofty multiples, often get taken behind the shed and get torn apart pretty brutally. So we're starting to see that as well. And I think, given the inflation we're seeing out there today as well, there's certainly going to be continued upward pressure on rates. I don't think that's anything that any of us don't know at the moment. I think we all know that that's coming, and there's going to be further upward pressure on rates. That'll continue most likely to put pressure on higher multiple stocks, longer dated cash flows, from a discount perspective. So I think that's playing perhaps a bigger role today than it would have back then, but it's certainly front and center today.
So Steve, I want to zero in on that because I don't think a lot of advisors are picking up on the nuance there. Growth stocks have a higher multiple because of that discounted cash flow mechanism. So correct me if I'm wrong, and Jackie, pipe in here. What you're saying is, as the cash rate goes up, that discount pricing model, you're going to have to, the present value discounting mechanism makes it so that the higher the cost of borrow, the lower the today's present value of future cash flows is going to be. And so the question really is what's the difference between a growth stock and that discount mechanism versus a value stock and the discount mechanism? Shouldn't they both be brought back at a lower price in today's prices, or is it just relative multiples that is what people are looking at?
I could chime in here a little bit. I think the big difference between value and growth in that regard is that value stocks tend to have their cash flows a little bit front end weighted, or at least balanced in terms of the profile of the company. Whereas growth stocks will have a lot of their cash flows occurring in the future years, maybe sometimes even 10 years or 20 years plus. And you'll hear a lot of companies that aren't generating cash flows or profits today that are expected to generate a lot of cash flows in the future, maybe far off into the future sometimes. And so what we call that is long duration. And it's not unlike a bond that has a very long time to maturity. And if you map that out in terms of the years and the time it would take for you to receive your repayment of capital, growth stocks are a very long duration asset. And what happens is if you put all of these models into a DCF, the growth companies will end up having an outsized impact when you move the discount rate, when you either raise or lower the discount rate. In this case, because interest rates were falling, you're lowering the discount rate. And so, they had an outsized impact on the multiples that were attributed to these stocks as well. And that's really the differentiation between value and growth in terms of just coming at it from a bottom up fundamental standpoint is how long do you have to wait before you can expect the cash flows? And how visible are they? When we're thinking about stocks as value investors, we like to look at companies that are generating cash flow today, companies that have demonstrated a history of generating cash flows. And they may not be growing much faster than, it depends on the instance, but they may not be growing much faster than GDP or a little bit higher than GDP growth rates. But at the end of the day, their valuation is supported by past and existing cash flows. And that's what we like to hang our hats on. That's where we find stability, especially when you're thinking of companies or portfolios that pay a meaningful dividend, like the Focus Dividend Fund that Siona runs. We're always looking at dividend payout ratios. How well supported are the dividends by earnings and earnings growth?
Yeah, it seems to me like it's an interesting, we can talk about the discounted cash flow. A lot of people don't understand that even, but just from an intuitive perspective, when cash is cheap, I feel like growth stocks are able to tell a story. And because it's so easy and simple to finance that, you'll get more willing players in that space. You will get more of the cash flow, and the loftier the dreams, the longer the goals, the Teslas, the going to Mars, the building out, a new infrastructure, whether it's, I would imagine that I certainly see crypto as a growth area as well. These dreams are easy to fund when cash is cheap. And you always have tangible assets and tangible companies there when you need them, if you need them. The moment that inflation goes up, you get a lot more uncertainty. And all of a sudden, you wonder whether they're going to be able to afford to do this, whether people are going to be willing to pay for Netflix at the rate that they're paying for them. And maybe, budgeting comes in and you're looking to actually spend money in real things, real companies that are providing real goods today. And I think from an intuitive perspective, Stephen, correct me if I'm wrong, I'm just trying to get the intuition here, is that when things become unclear about the future, tangible assets and tangible companies that are doing real things today end up winning. Is that kind of like a human intuitive way of thinking about value versus growth?
I think you're right. And the way, you tie that into the current environment, I think you're absolutely seeing that today. Certainly in an inflationary environment where, we haven't seen that in a long period of time. And we're seeing a bit of a runaway inflation at the moment. But even if we're, if we settle in at something at 4%, that's still going to be like 100% higher than we've seen in the last decade. So it's going to have an impact, and hard assets, tangible assets, as you point out, are beneficiaries of that. And I'd also say, just going back to the question of, the point of Jackie was making about long duration assets and the comparison even to a bond. What was interesting too over this recent period, it wasn't just, the high tech, sexy growth stocks. When you look at the consistent earning streams and cash flow streams of a consumer products company, and you look at some of the big global BMS like a Nestle or a Diageo on the alcoholic drinks side, these businesses tend to chug out very consistent growth, but nothing spectacular. Something maybe 4 or 5% organic growth. But because given the nature of those cash flows and the consistency of it and the low rates that we had seen, and we think about that discounting mechanism, the multiples accorded to those businesses in recent years just went through the roof. I remember buying Nestle back in, the early 2000s at 11 times earnings. It was knocking on the door of 30 times earnings recently. So it has a big impact, and the underlying business hasn't really changed. It continues to deliver the same types of growth as it has in the past. It may do a little better in an inflationary environment if they can pass through the cost increases, which companies like that tend to have an ability to do so because they have strong brands. But those are some of the unique phenomena we saw in the last 10 years or so. And I think companies like that as well, not just tech companies, but companies of that ilk in the consumer product space are likely to see some compression in multiples also going forward.
It seems like a lot of the, like from what you're talking about, Stephen, which is not, outside like X technology, these companies that have aspirational valuations are also subject to, I mean, technology stocks are aspirational for sure in terms of what, Rod was just saying, but in terms of a company like Nestle, for example, having fetched what you could definitely call aspirational valuations, that's very interesting. I mean, I think that's something that might be overlooked as far as long duration is concerned. What I'm curious about is because of Rodrigo's question a moment ago, which was that why is it that long duration stocks are getting killed by the rise in rates? So I'm curious to know, is there a, you have these high multiple stocks, high duration multiple, and multiple stocks, and then you have, you have value stocks here, but is there a mean somewhere in between that you consider to be like the median, the meeting point of those two currents, like where you have long duration stocks getting compressed, and then now we're seeing value stocks rising? Is there some meeting point where the like a supply and demand curve where these two types of investments meet?
That's an interesting question. I think certainly on the extreme end of things, where you have businesses that really aspirational, where even they're not cash flow positive, but it's an exciting story. There's high growth rates on the sales on the top line, and the story, the earnings capability and the free cash flow and the cash flow streams are out there in the future at some point in time. I think that's where the discounting mechanism really works at a low rate for those types of businesses. And when the rates start to change, those cash flow streams out in the distant future start to come under a microscope a little bit more. I think if I understand where you're coming at this from, so we certainly could also see a market multiple get compressed in this environment. You go back to the 70s, I suppose, when we had a really high inflationary environment and market multiples were lower than they are today. But also keep in mind, certainly a market like the US, which is the biggest in the world, has been so heavily dominated by these high multiple stocks that, just having them coming back down to earth to some degree is going to compress the overall market multiple. And to your point, maybe some value stocks or stocks that perhaps have been labeled value may not appear as much of a discount to the market multiple going forward if the overall market multiple is compressing. But I think at the end of the day, it really just comes down to the individual businesses. And again, what price we're paying for those companies. Are we getting the margin of safety we require? And that, for us, that doesn't change.
So
Okay.
I'm just genuinely curious. I like to ask this of every value manager. We've addressed kind of the macro cycle that tends to affect value positively and growth negatively over time. And you've also mentioned how I think there's a value system for every value manager, a religion almost, that you want to find something that makes sense to you. It's something real, something tangible, a company that has growth but also dividends, and it's tangible in many respects. But understanding how this ebb and flow between maybe growth and value, or maybe value and momentum, one paper from AQR pointing out that they're better together. Have you guys ever thought about complementing your philosophy with some momentum in order to be able to play both sides of that coin? Or is the marriage to fundamental value investing too much at this point?
What's recommending?
It's a strong marriage, a very strong marriage. It goes back to that notion that this works over time. And it tends to work over time with less volatility along the way, at least the way we apply it. And so it's a less bumpy ride. So we feel we're not, we're not rolling the dice to get that return. So, it's just a less bumpier ride along the way. And, I think the notion that it can consistently work. And as I said earlier, it was still working in an absolute sense. It just didn't look like it was doing much relative to the explosive growth of some of the stocks that were leading the markets. But on an absolute basis, it was still working largely. And we think that'll continue. So it's a style that also, from my perspective, and I think I could speak to every member of our team, it matches our personality. It's hard to do more than one thing, I think, and do it well. So, I think our investment personalities match our style really well. And I think you need that in order to stay patient and consistently apply your process over time, no matter what the market climate might be. And that's what we have tended to do. And everyone the teams I've been on over the years tend to follow that approach, and it's been a successful approach.
I'll add as well, we think about investing as being business owners. And so when we pick companies to invest into, we want to see it supported by cash flows and revenue growth and cash flow growth. And that's how we can trust that our capital will be returned in due time and not burned away. Right. That's the fundamental tenet of value investing. And that's something that doesn't necessarily exist as strongly in momentum investing. Those, momentum investing as a strategy has an entirely different set of tenets. So it makes it hard for us to then switch gears and try to do that type of investing. I'm not saying that it doesn't work. I think there are investors that do it well out there, but it would take us a lot of brand new training to get up and running.
It's an interesting time. I think that there's a whole generation of investors right now. That was also part of my thinking when you were talking about your bio, Jackie, which is that, you came in 2013. There's a whole generation of investors who don't even know what that is, right? They don't know what investing according to fundamentals is.
Yeah. And I would actually add to that as well. If you think about what happened during the 2020 pandemic, a lot of retail investors, were stuck at home, locked down by the pandemic, and they found themselves with a bit of excess savings, either from government support or from just overall household savings. And a lot of that money went into the capital markets, into the equity markets. And so these were brand new investors, as you say, coming in, and what they observed and what they saw and what they learned was this weird style of momentum driven investing. A lot of meme stocks getting popularized at the time that were getting bid up into the stratosphere and just not good, fundamentally anchored investing. And subsequently, we saw what happened to that bubble, as it were. And it came back to invest them it came back to bite them. And that's the problem when you're coming into this game, into this strategy without a good long-term kind of fundamentally driven strategy.
Yeah. I was, I had a, had a thought, Stephen, when you were talking about how, on an absolute basis, value had decent returns, just not as good as growth. And, it reminded me of Talladega Nights, the Will Ferrell film where, his dad tells him, if you're not first, you're last. Right. And, almost like, even despite the fact that value had returns, it just got dragged through the mud for 10 years. Oh, value's dead. Value's over. This is, we're done with this. And so anyways, it reminded me, but it was a great point that you made, which was that, you can own value and growth or momentum in a portfolio together, even if one isn't performing while the other is, because you certainly want to be there and you want to be diversified across these, across styles. for when the transition comes that we've gone through the last 6 months, a year, with the shift away from momentum or high duration to what's happening today, which is we're having this very positive shift to value.
Yeah.
And that may be a portfolio construction approach, the way you think about, having things that say when I think everything else zags. But I do take Stephen's point that you want to be really good at what you do. And you want to be, and if you want that team to be a value shop, the idea of religion and personality matching and focus is valuable in this industry.
Yeah.
When everything is a squirrel looking for the nut. So I understand the value of having a value focused shop. And then I also understand the benefit of diversification across different styles for the portfolio allocator or the asset allocator. But anyway,
well, it's kind of hard to have, like either you have a high conviction about hope, or you have a high conviction about, real earnings, real dollars and cents. So you can't.
Growth managers think value managers are chumps and vice versa, but that's what makes it market.
It's interesting because, the point you were making there, Pierre, about, the style still on an absolute basis doing well. I can't remember the exact numbers back prior to the tech bubble of 2000, but in a similar way, anything that was non-tech in those days was considered old economy, and no one wanted to touch it. So, I think from an absolute basis back then, it struggled, but it was such a shorter period of time, relative to the recent underperformance. So yeah, and Rodrigo, to your point about the team, and we have great diversity of opinions and input on our team, but from a point of view of all singing from the same songbook, we do, and that's so important. But it doesn't mean, as I say, we don't have good diversity of thought and opinions across the table. But it's so important to be rowing in the same direction.
So let's talk about that, the diversity of opinions within the shop, because we've had many debates about the definition of value. So just background for us for Resolve is that we are quants. And so there's many ways, many metrics. And I understand that you guys have a quantitative filtering mechanism, and then you get into the value, the fundamental side. What is value? Is it price to book, price to equity, price to sales, and enterprise value to EBITDA? There seems to be a lot of data mining on people that said the price to book was dead. Are those the types of debates that you guys have? Maybe you're not having it from the academic definition of these ratios, but maybe what a valuable company looks like, and how does that debate happen internally?
Yeah, I'll start off, and Jackie can contribute on this for sure. We look at businesses in many different ways. I think, you look at what we screened for, and maybe, the original models we had in place that our founder had incepted decades ago, a quantitative approach that involved more, of a book value, relative PE multiples, normalized ROEs, et cetera. And we still use, it's been tweaked over the years, but we still use that as a screening tool, and it doesn't work across the board for every industry or business, but it's a good tool, and we've combined it with many others. So, I wouldn't say that metric is dead. We still use it, and we still throw it in the pot and look at it along with many others. So a lot of it depends on the business, the industry. We're big looking at free cash flow. We always want our businesses to be, generating free cash flow over time. We look at EV to EBIT, EV to EBITDA. Some businesses require more of an asset value approach, certainly in the resource space, the material space, real estate. Jackie can certainly attest to that. So it's not one and one only across the board. It's that whole notion of understanding the business that you're going to be buying into, and what are the drivers what are those cash flow and earning streams or operating earnings? What are they going to look like 3-5 years from now? And use those inputs to develop what we think is a fair value for that underlying business. Now, we tend to be very contrarian in our approach also. And that's a real common theme across all our portfolios. We tend to be buying businesses that are going through some transitory issues. We're long-term thinkers, so we don't really care if, a business is going through some issues that may last a quarter or two, and perhaps even 3. We're not looking to make a home run by, at the next 6 to 12 months. So we take advantage of those short-term transitory issues in a business to buy something at a discount. Now we have to get a clear understanding that these are transitory issues. And, when we do have a strong sense of that and our conviction levels are there, we're often doing things in the marketplace that others have, no interest in doing so, because the market overall is very short-term focused, as we know. So the notion of saying, thinking that, we're going to be patient on this one for 3 to 6 months is not a common thought across the marketplace. And we take advantage of that to buy into these businesses that are good, solid businesses from a long-term perspective when they're going through a short period of turbulence. So that's also a common theme in our approach. But Jackie, maybe you can add some thoughts to that.
I would just add that value, at least we don't think, is just any one multiple, right? There is some evidence out there that the price to book multiple, for example, is becoming less relevant. We think that's because, companies are becoming more asset light over time. Then the book value of assets is no longer as indicative. Similarly, price to earnings as a multiple is also, we think, losing a little bit of relevance too, with the treatment of things like R&D versus capitalization and amortization. These are particularly meaningful for tech companies that have a lot of R&D, which one might argue should be capitalized because it does form a key part of their asset base, or for serial acquirers who tend to amortize some of the purchases over time. And so both of those things would actually depress earnings and lift the PE multiple higher than it would initially appear. So our definition of value is, understanding the sum total of cash flows that will, I guess, in all likelihood, be made available to shareholders over the life of the company, to essentially repay the investor's capital investment, right? And so I think adjusting for those nuances that I mentioned is the key to identifying where value actually lies, and defining value. Now, we're also happy to use different multiples or models as is applicable for the specific company that we're looking at. For example, in real estate, we're always looking at NAV and cap rate valuations. In insurance and financials, we're looking at book value. That's an industry where, price to book multiple is much more relevant. In other areas, it's going to be cash flows and earnings. And then even within that, distinguish, even within that, there are differences between different companies as well. There are some financial companies that'll actually use an earnings model to value and vice versa. So I think that's one of the advantages of being an active investor as opposed to a more passive or quant-driven investor is we can kind of use our discretion to determine what's appropriate in which instance. And we'll jump between price to earnings or price to cash flow or price to NAV or price to book or even dividend yield as necessary.
Now, you guys seem to agree wildly with each other. What are the disagreements that happen internally that actually make it interesting and possibly make it a better investment process? What are the things that really get you guys going internally?
Great question. So
Price of oil,
The macro side.
yeah,
I'm kidding, Stephen. Go ahead. Yeah.
no, I think that's you might have touched on one right there, Jackie, and maybe we have sector expertise amongst the team, but I think for the most part, we have a real generalist overlay too. And, nothing's done in a silo. The team, we interact, we discuss new ideas, we discuss the portfolio as a group. So there's a lot of knowledge that's built right across the team, across the sector. So we may have an individual who's really good on the energy front, but the others are involved in the research and involved in the discussion. So there's a lot of good points and counterpoints across the table. So obviously that in itself will create some good contrary discussion at the table. Whereas someone who has deep experience in analyzing oil and gas companies and may have views on the commodity itself, which you kind of have to in those sectors. You can't do it in a vacuum. You need to have, we're not top-down investors, but you need to have views on the commodity space. Others around the table might not have good knowledge on the space, but not as deep. Will have opposing views from time to time on where we might be thinking about commodity price inputs and where we are in the cycle, et cetera. So those types of discussions come up, and I'd say they come up with other sectors as well. Jackie does a lot of work in the technology space, and multiple discussions in terms of what kind of multiples we want to put on businesses in that area, especially what we're going through right now. The whole space seems to be pressured. So we have those discussions where, should we be taking our multiples down? Should we be thinking and being a little more conservative in some areas? So there's good discussions around the table. We're not, although from a style perspective, as I said, we're all singing from the same songbook. There's a lot of diversity of opinions and thoughts that go into the decisions. So, Jackie, you have some additional thoughts on that?
Yeah, certainly. I would say that our investment process actually builds in a lot of disagreement from start to finish, right? One person brings an idea to the table, and everyone actually gets a vote from junior analysts all the way to CIO. It's an equal vote on what's the fair value of that company, whether they agree with the analyst assessment, and whether to buy that stock. And so those, of course, those votes get tracked for performance purposes as well. And we leave ample room for disagreement. You can certainly use your own background and experiences to color your expectations of the stocks and your input of the stock and your valuation. And that's where the disagreement comes. We get together and we debate about, we think the earnings growth of this company is not going to be as rapid as stated in the report, or we think the multiple that it deserves shouldn't be as high, or maybe even higher than what's been ascribed. And so, those are what forms our risk management procedure, or parts of our risk management procedures as well. It really stops us and allows us to address and identify an individual manager or analyst's personal biases, because when you're running a portfolio, there's always all kinds of biases that get ingrained into the portfolio and into the names that you decide to add to the portfolio, or that you want to add to the portfolio. And it's up to the rest of your team to be able to kind of pick them out and really point them back to you and say, hey, how do you think of this? What have you thought about, this factor or this idea? And does that change your view? So I would say that's kind of the foundation of our team's discussions.
Fascinating. Let's change gears and talk about your outlook and your views on the market and where you see the opportunities right now in your space.
Yeah. So Pierre, as I mentioned, when I came to Siona, my focus was to build out a global initiative for the firm, and we've been doing that. And obviously, I still wear a hat as a co-CIO, and I have my head in Canada a lot as well, which is good. And then this frankly is the approach we're trying to take. Is approach that I had taken in the past with Harvard funds. We had a tight knit, cohesive team that was integrated. So we did Canadian and non-Canadian as a group, and I think it really broadens the research, and it really broadens the focus of the PMs and the analysts on the team. So this is what we're trying to build here, and we as you mentioned on the outset, we have a global fund, a U.S. focused fund, and also about a year and a half ago, we launched an international strategy, which is an EFI strategy. And we have we certainly have a year and a half under our belt on that, and we're getting some good outperformance of about 1,200 basis points since inception on that one. And that's one that really excites me, to be honest. When you look at the multiples of the U.S. marketplace, certainly at the end of last year, I think we were about 22 times earnings, or forward-looking earnings on the U.S. And the U.S. at the end of the year was 69% of the MSCI World Index. So it had grown to I think, the largest size within that index that it had ever seen. So that's really driving the global indices as well. And I think the global index, MSCI World Index, was around 18 times earnings, maybe a little bit more than that at the end of the year. But when you look at the world outside of that, the global markets outside of the U.S., developed markets, far cheaper. Europe around 14 times it was at the end of the year, a little cheaper today. Yeah. Japan at 14 times, which, given Japan's history over the last 20 or 30 years, also very cheap. Canada has been cheap around 14 times. UK was exceptionally cheap, just over 12 times earnings. So we feel we're getting more bang for our buck in those markets. And there's been great outperformance of the U.S. market relative to other areas of the world in recent years. So, the U.S. market, I think over the last decade, at the end of 21 was compounding at over 16% for 10 years, which is extraordinary. 100-year average is something like 8%. So over earning for sure. But that's not always the case relative to other parts of the world. And there certainly there's been lengthy periods when the world outside of the U.S. has outperformed for long periods of time. So we see that reversion to the mean occurring going forward. We're finding good businesses in those markets that are growing at very interesting rates, and we're paying very little for those cash flows and earning streams. We're certainly going through some challenges in Europe at the moment with the war in Ukraine, which is depressing multiples even more. But I find what tends to happen, and I lived through the European financial crisis not too long ago. A lot of things get painted with the same brush, and you may be domiciled in a certain area of Europe, but your business is global in scope, and you have profit centers around the world. And I think investors sometimes lose sight of that. So we like to take advantage of those misconceptions from time to time, and buy into these businesses that we think are at very attractive prices. So I think the markets outside of the U.S. are priced such that there's a far greater chance of getting above average returns from those markets in the next 10 years relative to the U.S. So that's an area of the global markets that really excite us today. And of course, Canada, and you've had Kim Shannon on your program, and I know she's waved the Canadian flag, and rightly so. Multiples in Canada also are very attractive today relative to the global indices.
Not to mention a commodity-driven economy, and this continues. It might be we might be off to the races. So can I ask you about that concept of a company domiciled in a country with a misconception that it's a domestic stock, but rather it has global center? There's always, every time I talk to a domestic U.S. manager that claim to be international, they always point to the fact that the U.S. companies, a lot of the U.S. companies that they buy into also have international centers, and they're mostly an international companies. So is there any truth to that? And if so, do you invest in American companies in your international approach because they're multinational, or do you not, and why not?
So take this last part first. No, in our focused U.S. product, we're solely investing in businesses that are domiciled in the U.S. Now, are we attracted to businesses that are global in scope and have those profit centers around the world? Absolutely. It's not. It's we don't start at that point. We just as we don't start looking for geographic exposure or industry exposure. It filters from the bottom up. So, if we find businesses that have, those attractive attributes we're looking for at the right price and they happen to be global in scope, then that's great. But I think just on average, in recent times at least, those businesses that you cite have been like their European counterparts, their European cousins have been much cheaper. So you're paying less for those growing cash flows over there than you had been in the U.S. marketplace. Some cases maybe justified, but in a lot of cases, we think, unfairly so. So I think that's what has been created some opportunities. But we tend to build our portfolios from where the business is domiciled. So, if we're investing, if the fund is a U.S. fund, those would be U.S. domiciled businesses.
I think what's also important to us as well is not just where a company generates its revenues, but also how is it able to perform in the markets that it's participating in. And what I mean by that is that oftentimes a company that is very dominant or has a oligopoly or dominant market share in one country doesn't necessarily translate to other countries. They tend to get they tend to not be able to replicate their strong competitive advantages in a new geography. And so, and then there are the companies that are able to transplant those borders and transcend those borders and expand their market share, expand their market capacity that way. And so, for us, it's really about understanding how is a company able to do that, and what allowed them to do that, and understanding that they were able to leverage their existing know-how and competitiveness in their home country and expand that outward and be able to capture global share that way. And then, of course, there's always the analysis of the specific industry itself, which can differ between different countries. So to raise an example, the healthcare industry in the US is obviously very vibrant. A lot of other countries actually have some mix of publicly provided healthcare, and so it doesn't necessarily lend itself to the same depth of sector in those markets, or they may have more government control and more regulation that disallows the companies to generate an excess return. One very good example in Canada would be the telecom sector, where a lot of the telecom companies in Canada, including your favorite TELUS, Rogers, and Bell, earn a reasonable return on their assets and are able to raise their prices year over year. Whereas in most, if not all, other developed market countries, the price of telecommunications and cell phones and internet service is actually deflationary. Is actually the prices have been coming down and competition has been intensifying. That's one of the rarities in the Canadian landscape, and you can call it, regulatory capture, or you can call it, just regulatory protection. But at the end of the day, this is a sector that has proven to outperform over the long run and proven to be defensible against new and existing competitors. And so when we're looking across the world and we think to ourselves, okay, where do you want to be fishing? What kind of, which countries' telecom companies and assets do we want to own? Well, it's naturally going to be the one where they exist and play in a very friendly competitive environment, and we had to look no further than Canada for that to occur. And so, a lot of the stability in cash flow that our thesis is predicated on, relies on that friendly environment continuing.
Maybe I'll just also just share an example, Rodrigo, because you touch on a good topic here, a good point about, where businesses are domiciled and where they're getting their profits from globally. I touched on the European financial crisis, and that was, again, a period where I felt a lot of things were getting painted with the same brush. We were investing at the time in an Irish company that was in the food ingredients business, and it was very global because its customers were the Nestle's, the PepsiCo's, the Krafts of the world. So they followed their client base around the world. But because at the time, Ireland was one of those pig nations, along with Greece and Portugal, and there's a lot of, macro concerns about these countries that, everything in Ireland was getting, again, tarred with that brush. But from an underlying business perspective, we saw a wonderful little company here that, what was going on from a macro perspective wasn't really impacting the business. And that created, again, a wonderful opportunity to buy into a growing company at a much reduced price. And I'm seeing some of this again today, certainly with European financials and banks. The banking sector in Europe today is not what it was a decade ago. There's been a lot of repairing of balance sheets over the last decades. Capital positions are very strong relative to back then. They've done a lot of repairing, as I suggested. A lot of companies are in excess capital positions relative to increased regulatory levels. Regulatory levels that have really increased over the years. So we're even well above that. So, I'm starting to see some of that again, where things just, memories are short. That was a painful period for European banks 8 to 10 years ago. And memories are short. And I think, first reaction is just to sell. And so I think that's creating some interesting opportunities as well. Again, you have to be selective, and we are. We're not just taking that shotgun approach. We're finding individual businesses that we think have, the credentials that we prize, and buying them at a reduced price. So we do look for these disconnects. And that's often a common theme in what we do.
Now, do you guys invest in developing markets as well?
No. It's a developed market focus. I've always been a developed market investor and portfolio manager. I haven't delved into the emerging economies. And, I think it's just perhaps maybe not as much as I thought a decade or more ago, but it requires a bit of a different skill set, I think. With developed markets, accounting standards, et cetera, are relatively common, and we have access to businesses that I find that we can discuss and call up and just talk to management teams, and you get access to management teams. They may come through town. So I just, it's hard to be all things. And this is where our focus has been. We feel we can apply our process in a consistent manner, in those markets, as we would if we're researching and investing in a company that's based in Toronto. We're going to take the same approach in terms of how we look at that business, whether it's based in Toronto or Paris or Tokyo. So, and I feel you might have to give some of that up if you're delving into the emerging economies.
One of the arguments that's made quite often is that markets are so efficient now because of all the data and technology that it's very hard to uncover inefficiency. What are some glaring examples that you can think of in recent history where you found opportunities that marketeers would claim don't exist anymore, or are all arbitraged away?
Yeah, it's a good question. And I think, A lot, as I said, a lot of it for us is more those shorter term disconnects where the emotions of the market get in the way, and a business will sell off because of near term concerns that, if you dig deeper and you understand the issues and you're comfortable that they're more transitory in nature, creates the opportunity. Whereas the market participants on average either just don't have patience to hang around, or they don't have a full understanding of the issues the business is dealing with and run for the exits. So I think for us, not always the case, but largely those are issues that we're dealing with. The disconnect is really that the emotional side of the market where the greed and the fear come into play, and we try and take advantage of that. Jackie, would you agree with that largely? That's how we are doing things?
Yeah, I would say so. And I think that, at the end of the day, markets are still comprised of human actors, and emotions often get in the way. Exaggeration or overreactions can occur. That's why we had the big bust in a lot of these profitless tech companies that we saw over the last couple of months, right? That's an indication or one example of inefficiency in the marketplace. And when it comes to market efficiency, we don't like to say that the market is fully efficient, but there does need to be some form of efficiency taking place for there to be rational price discovery. When we invest in a company trading temporarily below fair value, we need market efficiency to bring that price back to fair value within some amount of time, right? That price discovery mechanism needs to work at some point in the future for us to kind of have any form of profit or outperformance in the stocks that we own. But I mean, even just thinking back to what happened over the pandemic, and when we saw the March 2020 market crash, we saw different sectors become very disconnected with the underlying fundamentals. We see examples of irrationality and market disconnects, all the time. One sector that I fondly remember was the auto parts sector. Going into the crash, a lot of investors treated it, and rightfully so, treated it like a garden variety economic downturn where economic demand was severely suppressed. Production runs were limited and brought back in. And a lot of these automakers and auto parts suppliers had to rein in their capacity, reduce capacity, either by reducing production shifts or closing down various production lines. But then in very short order, it actually became apparent that this wasn't your typical economic downturn. And the demand for autos actually skyrocketed. You saw price indices for used vehicles actually more than double within, I think it was the span of a year. Because there was a massive shortage of vehicles. Everyone needed a car. Everyone was trying to get to move further away from the city, to distance themselves, to travel within the country since flights were not operating. And everyone had excess money lying around, excess household savings to spend on a new vehicle. And so that was one part of the economy that was actually roaring over the pandemic, the post-pandemic period. And it's expected that there still remains a lot of pent-up demand in auto vehicle buying that will occur over the next, let's call it, 4 to 5 years or so. And I remember, watching these auto parts stocks get rapidly repriced as that narrative kind of flowed through the market, and as market participants started realizing what was actually happening. These stocks went from all-time lows to double and triple within a very short period of time. So I look at an event like that, and I think there's no possible way that the market can be can be fully efficient, despite all of the computerization, the quant modeling, and all the Renaissance capitals in the world that are trying to eke out every last drop of alpha from this market. The simple fact is that a lot of things that happen in market are hard to predict. History often rhymes, but doesn't replicate perfectly. And so there's always going to be a little bit of give and take around the edges, around trying to predict or forecast the future, and around properly pricing these assets to reflect their underlying fundamental value.
Then economist and Amos Tversky talk about that as being the cascade effect, right? The idea that you first some news hits the newspaper and it's in the back of the newspaper, and it slowly cascades from the back to the middle to the front. And once it's front news, then it's over. And a discerning manager might be able to catch those back news stories early to be able to benefit from that cascade effect. So the idea of perfect information, the markets are highly efficient, just not efficient enough not to be able to find these little opportunities, for sure. That's very
and Stephen also commented on that idea of having a differential view between short-term versus long-term. And that's often where we find a lot of our ideas. Going back to the auto parts example, we happen to think that there is a short-term disconnect in terms of the negative sentiment around the auto parts sector and auto sector that differs widely from the longer-term prospects and future potential that still exists in this space. We happen to think, and that's still a thesis that we have today, that we've reflected across our portfolios. We happen to think that there's tremendous further potential for automakers to kind of take on more, for auto parts suppliers to take on more outsourcing from the automakers and provide the backbone of electric vehicle componentry. But meanwhile, in the short term, there has been a lot of disruption in the Russian and Ukraine situation. It's actually disrupted a big portion of the supply chain that was involved in that industry. And now we have to add to that this specter of an economic downturn that everyone tells us is looming. And so, since the year started, this industry, the auto parts industry, has sold off close to 30%. And so, all in all, the sentiment for auto companies and auto parts suppliers has been very, but in the longer term, which is where we like to fish and think about and play, there's an outright shortage of vehicles out there that continues to persist. There's still, latent and pent up demand out there for vehicles, used and new. And there's going to be a period of rebuilding of inventory that needs to happen as this normalization occurs as well. And so we think that could be a multi-year kind of tailwind for these companies that would drive earnings and returns for them. But again, they're being priced off of the short-term sentiment at the time being.
That's very interesting, Jackie. Very interesting, because it is what's happening currently is we've gone from a decade where you have this period of benign inflation and persistent growth and global collaboration and globalization, where just-in-time inventories was the way to go, and you were a chump if you held any inventory on, right? Because that's how it went. The world had been fixed, everything worked smoothly, and it's interesting to think that that's changing, right? We're becoming more nationalistic. Companies have recognized that they need to have inventory. So this idea that we're going to go back to normal is actually incorrect. The idea that we're going to go beyond the normal and have to have inventory on hand be way, way above what we had before is an interesting kind of cascade story that will may affect the automaker industry. That's very compelling story for sure.
So I was just going to say another interesting area. You talk about cascading, and was certainly in the back pages, was the energy industry.
Mm-hmm.
And, I think we've done a very good job. We were well positioned a couple of years ago, early, but, and it was a thesis based not on what we're seeing today. Obviously, we couldn't determine that what's happening over in Eastern Europe, but it was a thesis based on, fundamentals.
CapEx, ESG, all that
Yeah,
stuff.
absolutely.
Mhm.
And it all lined up well and made a lot of sense to us. And, we saw an index that was, energy index got down to, or the energy component of the S&P 500 got down to what, 2% or maybe just under that. And so, nobody wanted to talk about energy and no one wanted to touch it. So we were very
Is energy S and G now? Well, outweighing the E? Are we allowed to invest in energy as ESG managers yet? Or
Well, we believe so. The approach we're taking, and we're looking for businesses that are making improvements and have a path to certain emission levels, not just on the E side, but also on the S and G side as well. The G side is something that's, we think, for the businesses we've been involved in, have been covered very well over the years, but certainly doing a better job on the S side too. But these businesses, we need them.
Yeah.
And the interesting component we feel is this whole capital discipline that's real this time, and I don't think it's fully appreciated through the market circles in terms of the ability for these companies to throw back cash flow to the shareholders. It's starting to occur, and it plays a very big role in our thesis.
right.
So,
And those are very big cycles too. They take long to turn around. So it's
Yeah.
it must have been.
Yeah.
I mean that CapEx peak must have been 2015 or something. So I don't know how long you guys have been looking at it, but it must have been a long and painful ride until recently.
Well, we bolstered our positions, to be honest with you, probably within 12 and 18 months, and moved to a significant overweight. So
Very good.
yeah.
I'm curious to know what some of your favorite names are right now that and why.
Well, I'll give you some thoughts, certainly outside of Canada, and Jackie, you can chime in as well. But I touched on energy. So one company that is has a prominent position in our global portfolios is Shell, the big integrated producer domiciled in the UK. And three real kind of components to that business. One being LNG, the world's leading supplier of LNG, which liquefied natural gas, which we think is going to play a huge role in the transition to a greener economy. The second part of their business is the marketing side, or the retail end of it, which they have some 46,000 stations around the world, and so they're building and have that infrastructure to participate in an electrified world down the road. And the third component, which is the legacy side of things, is largely offshore production. They've sold off a lot of assets in recent times. They're not putting a lot of new capital to work there. It's kind of sustaining capital. So a lot of the cash flow that's being generated today from that side of the business, which is huge, is being funneled into greener energy sources and also back to the shareholders. I mean, we're buying the business at about 6 or 7 times earnings. At one point.
That's remarkable.
It is. They cut their dividend, and that created a real good opportunity for us during the crisis. So that's a prominent one for sure. And I don't know, Jackie, do you have one you want to chime in on?
Jackie, how much Twitter did you buy 3 weeks ago?
Yeah, I can safely say, unless I'm mistaken, there's no Twitter in any of our portfolios. But a name that I like that we own in several of our non-domestic portfolios is Fresenius. Fresenius is a global dialysis provider and dialysis devices provider.
Yeah.
And the pandemic has really interrupted dialysis treatment, and unfortunately, because their patient population is a bit more sensitive to COVID and diseases, mortality rates have risen in the short term, and these were unforeseen challenges. But we think the longer term fundamentals actually outweigh these short term hiccups. The company is positioned well to provide kind of new and improved products and services to combat the growing epidemic and changing the way that service delivery is happening for patients who need dialysis. And on top of that, dialysis and kidney disease is unfortunately a growing endemic. As nations become richer, become more sedentary, there's the increased incidence of diabetes and heart disease and other illnesses that lead to kidney disease. And so it is a long-term, fundamentally growing industry. They are kind of in the midst of this shift from, in-clinic services to kind of home dialysis and other forms of dialysis treatments. But we think that, this is a global leader in what they do. They built up a lot of expertise. They're creating value and this is the important part when it comes to U.S. healthcare, a lot of healthcare companies. They're creating value for the insurance companies that pay them and the patients that use them, and also kind of the government spending that happens for public healthcare systems as well. They're driving value throughout that chain and cutting costs throughout that chain in order to make themselves, more favorable and increase the economic value of the entire system. So that's a name that, again, we talked about short-term versus long-term expectations. Trades very cheaply today, kind of low teens sort of multiples. But is a very strong and dominant operator.
Wow. Dialysis, auto parts, and Shell. I mean, is it any wonder why no millennials want to invest in value anymore? Those are three of the most boring companies. It's a classic value move, right? Just so, oh my God, who would? What type of story are you selling? You need to get sexy with your pitches.
We can keep going, and it might put you to sleep.
No, it's okay. I think we're good. I'm kidding. I think this is it, right? This is where we transition to real things where people forgot actually add value to society.
Investing doesn't have to be sexy, right? Sexy gets overpriced.
That's right. There you go.
Stephen, Jackie, any parting thoughts?
Perhaps I'll just mention, we've been talking about, what we're doing at Siona outside of Canada. It's a shop that has a history of being very focused on Canada. And we're certainly building our non-domestic capabilities. And, some of these companies we talked about today, the one strategy that also is very interesting is this high conviction approach we take, high conviction strategy. And it's in the retail world, it's known as Siona Opportunities Fund, where we're combining the best ideas in Canada with our best US ideas, and then sprinkling in some of these European ADRs. So it's an approach where we can get, the best of our ideas from the different areas of the world where we're fishing into. So that's another, I mentioned the international strategy, the high conviction or the opportunities fund in the, as it's known in the retail world, is also something we're very excited about because, again, it's our best ideas. And just given where we're sitting today with this resurgence in value, and with the rates moving a little higher, inflation moving higher, we feel our portfolios are very well positioned to deal with this. Just given the underlying growth of the businesses and the discount we're seeing across our portfolios and the companies we own relative to the underlying worth of those companies. So we're still seeing good discounts across our portfolios that are pointing to above average returns in the years ahead. So that gives us great confidence.
Awesome. Well, Stephen, Jackie, I want to thank you very much for your time and your insight today. It's been a great conversation.
Yes. Thank you, Stephen, Jackie. Awesome insights.
Yeah. Thank you both, Pierre, Rodrigo. I really enjoyed that conversation. Great questions, and I think we got into some good topics of discussion for sure.
Thank you for having us.
Thank you.